Welcome to The Explainer. You know, every now and then an earnings report drops on our desks and presents us with what looks like an absolute massive contradiction right out of the gate. Today we're looking at the Q2 2026 earnings from CooperCompanies. They're a major global medical device manufacturer, and let me tell you, this specific quarter is just a fascinating case study in cognitive dissonance. I mean, on paper, it honestly looks like two completely different companies reported their earnings on the exact same day. So let's dive right in and see exactly what I mean.
If you just skim the headlines and the executive summary, you'd think they knocked it completely out of the park. Just take a look at this quote from Al White, the president and CEO of CooperCompanies. He says, "We delivered a strong second quarter, achieving record revenue and non-GAAP earnings per share, while marking our 10th consecutive quarter of exceeding consensus earnings expectations." I mean, 10 consecutive quarters of beating expectations? That is a stellar track record. He's celebrating record revenues, solid execution, the whole shebang. It really sounds like a total victory lap.
But then you scroll down the balance sheet and you literally hit a brick wall. And this brilliantly sets up the mystery we're unpacking today. Because despite the CEO's glowing review, the official unadjusted GAAP earnings per share for the quarter sits at negative 40 cents. Yeah, negative. That's a huge drop of 84 cents from last year's second quarter. So we really have to ask ourselves, how on earth can a company celebrate record revenues and 10 straight quarters of beating expectations while officially losing money and posting negative earnings per share?
To solve this mystery, here's our roadmap. First, a tale of two metrics. Second, driving the top line. Third, the elephant in the room. Fourth, behind the real numbers. And finally, looking to the future.
All right, let's jump straight into Section 1, a tale of two metrics.
The sheer scale of this operation is just incredible. CooperCompanies brought in a Q2 revenue of $1.082 billion. That is obviously not a small number, and it actually represents an 8% increase from last year's second quarter. Even when you strip away the messy effects of foreign currency exchanges, they still posted a highly respectable 5% organic growth. So right away, we can totally validate the CEO's excitement when it comes to the top line. The baseline growth is incredibly strong. Bringing in over $1 billion in just 3 months tells us that demand for their products is exceptionally healthy.
Moving on to Section 2, driving the top line.
Now, CooperCompanies isn't just one giant monolithic entity. It's essentially split in two. The much larger slice of the revenue pie is CooperVision, bringing in $723.5 million. This is their contact lens division, so your toric, multifocal, and spherical lenses. It's clearly the primary breadwinner here, responsible for roughly 2/3 of the total quarterly revenue. Then you have the smaller but still very significant slice, which is CooperSurgical, bringing in $358 million. This division focuses heavily on fertility and women's healthcare. But looking at total revenue only gives us half the story, right? While CooperVision definitely brings in the lion's share of the cash, take a close look at the organic growth here. CooperVision grew by a very solid 4%, but CooperSurgical actually outpaced it, posting a 6% organic growth rate. And within that surgical division, get this, their fertility products specifically saw an impressive 10% constant currency growth. So the surgical and fertility side of the business is acting as a massive growth engine for them right now. Both divisions are healthy and both are clearly expanding.
Which brings us to Section 3, the elephant in the room.
Okay, to understand that negative earnings per share, we have to look back a bit to December 2023, when the company initiated a voluntary product recall. For over 2 years, the outstanding claims and legal headaches surrounding this recall have been kind of hanging like a dark cloud over the company. Well, in Q2 2026, the company decided to just rip the Band-Aid off. They took a massive $271.6 million net litigation charge to resolve these claims. The silver lining here, and it's a big one when looking toward the future, is that the CEO noted they've reached agreements to resolve substantially all of the claims. That means they can finally put this whole issue to bed and move forward. Just for some quick context, this $271.6 million pre-tax charge specifically relates to a recall of embryo culture media within that CooperSurgical division. Because this involves fertility treatments, which is obviously a highly sensitive, absolutely critical area of healthcare, the resulting litigation and settlement costs were understandably huge. The company is basically absorbing the financial blow to make things right and finally close the chapter on this specific product issue. And the math behind this massive charge is pretty interesting. It wasn't just a flat penalty. The company actually accrued a staggering $324.1 million in litigation liabilities.
However, they're expecting $52.5 million in insurance recoveries to help offset a bit of that pain. So when you subtract the expected insurance from the total liability, you arrive at that final net pre-tax charge of $271.6 million. That single, massive line item right there on the balance sheet is exactly why the official GAAP earnings plummeted to negative 40 cents. The legal settlement simply wiped out the quarter's operational profits on paper.
All right, let's look at Section 4, Behind the Real Numbers.
Let's pause for a really quick definition, because you'll hear the term non-GAAP used constantly in finance. GAAP stands for Generally Accepted Accounting Principles. Basically, it's the strict, standardized way of reporting finances. Non-GAAP, however, refers to adjusted metrics. Management uses these to strip out one-time, highly unusual costs, like, say, a multi-million-dollar legal settlement or acquisition costs. By removing those outliers, non-GAAP numbers give investors a much clearer, cleaner picture of how the actual day-to-day core operations are doing.
So look at what happens when we apply those non-GAAP adjustments. The picture changes entirely. Because of that massive litigation charge, the official GAAP operating margin fell to a negative 3%. Ouch. But if you pull out that one-time $271 million legal charge, the non-GAAP operating margin jumps to a highly profitable 27%. Actually, scratch that. It's not just profitable, it's up 260 basis points from last year, which reflects some really meaningful synergies from a reorganization they did recently. So beneath that surface-level loss, the actual machinery of the company is running incredibly efficiently.
And this brings us full circle to our initial mystery. The GAAP earnings per share is that gloomy negative 40 cents, but the non-GAAP earnings per share, that sits at $1.21. And that $1.21 actually represents a 26% increase year over year. This right here is exactly what the CEO was celebrating at the very beginning of the explainer. When you clear away the legal debris of the recall, the actual business of making and selling contact lenses and surgical equipment is booming, and profitability is soaring.
Finally, let's wrap things up with Section 5, Looking to the Future.
Looking at their updated fiscal year 2026 financial guidance, they are projecting total revenue to hit somewhere between $4.285 and $4.321 billion. They're expecting steady, consistent organic growth across both wings of the business, between 3.5% and 4.5% for CooperVision and 4% to 5% for CooperSurgical. And perhaps most importantly for the folks investing, they're guiding for a full-year non-GAAP EPS of $4.58 to $4.66. Basically, they're telling the market, hey, that underlying operational momentum we saw in Q2, we expect that to keep rolling right through the rest of the year.
And just to put a final stamp of financial confidence on their outlook, the company reaffirmed a massive long-term objective. They are projecting free cash flow to exceed $2.2 billion for the fiscal year spanning 2026 through 2028. You know, free cash flow is the absolute lifeblood of a company. It's the actual cash available to grow the business, make acquisitions, repay debt, or buy back stock. Generating over $2 billion in free cash flow over 3 years, that is a massive indicator of long-term operational health, regardless of a one-time litigation bump in the road.
So there you have it. We've solved the mystery. A messy, expensive past collided with a highly profitable present, creating a really confusing earnings report. But when you untangle the two, a fascinating picture emerges. And this leaves us with a critical question to consider as we wrap up this explainer today. Now that the $271 million weight of the 2023 recall is largely in the rearview mirror, is CooperCompanies' financial vision finally clear for the rest of 2026 and beyond? Or will the dynamic global market throw yet another curveball their way? It's definitely a compelling story to watch unfold. Thanks so much for joining me, and keep your eyes on the numbers.